Ladies and gentlemen, our next session, Global Macros and Micro India, we have Mr. Santosh Singh, Fund Manager, Motilal Oswal Mutual Funds, joining us. He has over 16 years of experience across his tenure, and he was ranked number one analyst in India in the Asia Money polls for insurance sector continuously for 3 years from 2015 to 2017. Funds managed by him are Motilal Oswal Dynamic Fund, Motilal Oswal Multi-Asset Fund. Ladies and gentlemen, please join me in welcoming Mr. Singh.
Working? Excuse me. Excuse me. Yeah. 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 So thanks a lot for the introduction. And before I start, actually the topic is quite excellent because we actually last session ended with this topic, and I think every session we are covering this topic. So someone before I was sitting outside, and someone told me just before there was a comment that actually you know what nowadays market to किसी को समझ में नहीं आता है, and then how do you want to sort of explain it? Yeah, global macro. so. So this is the topic where we are trying to explain global macro and sort of how are we looking at the Indian micro conditions. Now, before getting into my presentation, I would say this is one of the quotes, and I'm a big sort of a fan of Howard Marks, and one of the things I was reading was that actually the good times always create the bad times. So bad times are not created automatically. These are the good times which create the bad times. And it's a 30-year of almost, I would say, excesses. In certain areas, 30 years of excesses or 30 years of sort of stability, which is now, and we generally, human beings don't like stability too much. After 25, 30 years, we like to see के unstable market कैसा होता है. So after 1990s, Russian sort of, the Russia crisis, after that, 2022, we have started with something which is a great global geopolitical risk, right? So one of the basic drivers nowadays, and which the last speaker was alluding to, that actually inflation would have come down, but suddenly what we decided, okay, let's do a war. So one of the bigger risks is geopolitical, either be it the Ukraine, Russia, or now the China, or which is turning out to be an opportunity maybe for us, but China plus one or something. The second part of the equation is that after, I think, 1980, when the interest rates in the US moved to, I think it was in excess of 15%, right? From there on, we thought, okay, 15 ज़्यादा है, let's make it zero, right? So we made it zero in a period of 25 years. So that was the another excess which we did. And the third part of the equation has come from the liquidity, right? So after 2008, I think the global central banks almost expanded their balance sheets by more than $20 trillion. And now suddenly we have got somewhere around $500 billion of reversal, and we are saying, okay, bahut ho gaya. But yeah, we need to see that the excess was almost 20 trillion. So these are the three things which I would sort of to keep in mind before I get into my presentation. And I have avoided all the slides relating to sort of the commodity because I was pretty much sure that it will be covered. So there's no commodity here. So first, but the biggest thing which I think is a problem for the US, and the US problems is everyone's problem nowadays, is their labor market. And actually, when someone would have told me, यार बहुत job creation हो रहा है, I would have said, अरे बहुत अच्छी बात है. Problem is that job creation is creating problem for them. Every time the data comes in, people are praying, yeah, job creation problem hona chahiye. Unemployment should increase. This is what we pray for. Next day the market will only go up if the unemployment in US increases. But that's not happening, actually. And the US central banks are also trying to, and that is one of the drivers, the labor market now, because the commodity cycle is now coming, because we can see the commodity prices, a little bit of disinflation at the commodity side, but the problem is the labor market. And that is, and then you can see that actually the job creation and unemployment ratios, they are just, the unemployment is just reducing there. The job creation is more than the unemployment creation nowadays. And that's where whatever the interest rate sort of increases, the problem is the inflation is not going to go down until they are able to sort of, and this is again a contradiction that they are able to create unemployment in the economy. So that's what we are pushing for. Now, see, this one I will skip because I think we have talked a lot about the commodities. And see, the other part which is played out because of all this reason is that simply our interest, our sort of the global currencies. And mind you, there are two areas, the global commodity producers and the global commodity consumers. And then there is US. Right? So the global commodity producers, other than Brazil and Indonesia, sort of the currency has depreciated quite sharply. And Europe, through its own mess, the currency in the Europe has depreciated quite sharply. So what we are talking about is multifold problems, right? We are, we are talking about one of the things. Uh, we are talking about actually three problems coming from global macro. One, interest rates have to move up, and they will make sure the interest rates will move up. Second, we are talking about actually inflation not coming down because US is not accustomed to seeing 7, 8, 9% inflation. We are accustomed to. And we were sort of, suddenly we saw today morning 7.4% CPI, and then we saw that, okay, inflation is increasing. But you know what, we had 7.3 was the actual expectation. It was the core inflation where we had a little bit of surprise. But generally, our inflation is, we are accustomed to seeing that 7, 8%. The US is not. And that's where they have to bring it down, and they are trying to bring it down. So second problem we are dealing with is inflation. Third is liquidity. It has to come off. Because I think the bigger problem driving the global consumption is the liquidity and the money which has been sort of thrown in the system in last 15 years, and more so during the COVID period. That sort of money which has been thrown in, which means people don't want to work actually. So, and with that in mind, what we see is that there is a clear dichotomy in the market. You know, US market is making, I was looking at NASDAQ made a new low, I think 2 days back. Or new 52-week low, or maybe and Indian markets, they are just off from the peak by some 7, 8%. So there is a clear dichotomy in the global markets. And then China is also sort of, it's almost like a lost decade for the Chinese market. So clearly, our premium against the emerging markets, and even amongst, I would say, among the global markets, is increasing quite sharply. And that becomes a cause of concern. That is it that we are into an era, we have never traded at this, and is it what Howard Marks talks about, the pendulum, we are at the extreme end of the pendulum on the premium side, or is it that our fundamentals have changed so much that this pendulum itself has to, so the median itself has to change? Is it either of the facts? Which, if we are on the other side, then we are looking at a sharp deterioration for us, but if the median itself has to change, then what can change that median for India? That's the key question nowadays to answer. So my view is simple, you know. So this forex reserve, right? We have never been so well sort of well off, although we have seen some a little bit here or there in last few months, but we have never been so well off on in our currency sort of currency reserves, and that's what is visible in our rupee, the currency you can look at. Actually, against most of the sort of big currencies, we have appreciated, other than US dollars. And somehow that cross currency is becoming a little bit of concern for the exporters who are exporting to the US. But yes, our currency is holding up very well, and our reserves are quite well. And so this was the slide which has caused the sort of deterioration in currency. And what you could see is that actually it's nothing. It's just the import of oil and gold which has caused that, and a little bit because of even the higher interest rates. So, and this slide I thought I'll explain. I'll sort of spend a minute on, because this to me is the scariest time, because what we have done is we have outperformed everything quite sharply, and within that global, and we don't live in an island. Means all these stories about decoupling, I think in 2008 I used to hear about decoupling. India is decoupled, world is going through a mess, and India will just outperform. This was what I used to hear in 2008. And again, I'm hearing that there is a decoupling, possible decoupling, but we don't live on an island. Means we are actually living in the real world, and the problems of US can become our problems. And as the last speaker was pointing out, that they actually own 20% of our equities. So if there is a problem, that can happen here also. And that's why we are seeing the sort of outflows we are seeing. The counterbalance is Indian retail, and that's because of all of you. The Indian retail has been sort of pouring money in the market, and that's what's keeping us up. So this is the problem which we are dealing with, that the valuations are valuations, is at the median, right? 19 times 1 year forward Nifty is a median valuation where we are trading at. And if the world is going through such a bad time, why should we trade at median valuation? We should go down below median, one standard deviation below median. Why that should not happen? But my view is that India now, the median has to shift of because of some of the reasons. See, our we are still talking about 7% GDP growth rate, right? The IMF has actually reduced its forecast to 6.5 just yesterday. And our RBI doesn't believe in reducing forecast, I think, nowadays, because the 24, they are still talking about above 7%. Still, that will be much, much higher than whatever we might be talking about. Actually, the globe, a lot of places might go through recession, right? So I would first come here and then I'll go back. Actually, this was one of my, this was sort of an eye-opener for me. This was the RBI's sort of survey, right? So we would have thought that actually so many things are happening bad, and that's why the consumption should fall. And why is it not falling? You can just look at the data, right? The perception on consumption is actually improving. With everything happening globally, the Indian consumers think that the consumption is going to improve. Everything is upward trending. And this is RBI survey. I believe they do a good work here. So everything is improving. I can't see anything which is anywhere falling. And the only thing people believe is going to fall is price levels. So this is telling me that India, as of today, the consumers are actually living in an era where they think they are going to be well off than where they are today. So, and if that is the case, see, the biggest driver for GDP or consumption is the investor or the consumer psyche. And the consumer psyche is quite bullish today. The last speaker was talking about that India has never seen people sort of changing or buying 3 shoes at one time. This is what is happening because you think that you're going to you're going to earn more, you're going to consume more. So that's one part, which is the consumption cycle. And consumption is very well placed. The other part is this one. And I think you have already seen this slide, but I'll still spend a couple of minutes here. Yes, if I look at our markets, what are the drivers to our market? Almost Nifty, I look at 36% of Nifty is just financials, right? And financials have not been in a better shape than where they are today. It's almost like last year, actually, I was looking at some of the data, and then the data was suggesting that financial sector is looking like they were in 2002-3, after the great mess of 1908 to 2002. And I don't know how many of you have seen that part. I think most of you would have. But 2002, if you would have looked at the NPL ratios, the sort of write-offs in the system, and the sort of capitalization level that were at a very different level. And that's what has happened over the last 10 years. So I was telling someone that actually financials, wo Ganga naha ke bahar nikle sare paap dho ke. So that is 10 years of sort of whatever was the excesses, they have come up from that. And they are at a very, very good position as of today. So this is one sector, I believe, if this is around 40% of the market, this is going to do really, really well. So the markets and the consumption, which is another 10-15% of the markets, they are not going to go anywhere because the psyche is quite bullish as of today. And the last one I'll just put in one way, because this is the sector which is which has got impacted, right? It's the IT sector. And the funny part is, last year when we used to talk to so many people, they used to tell us that actually, you know what, IT is a decadal story. Yaar, 10 saal tak to kuch nahi ho raha. Everything is getting digitized. The next 10 years, we are going to see 15% growth. Suddenly, I was talking to the same person yesterday. He was saying, sir, wo to sari story chali gayi. Ek saal ka tha growth. Now we are talking about a downtrend. Problem is, we never have a 1-year story or 2-year story. It was about the way in the markets, including me, we try to explain the market is after the price correction on increase. When the IT prices were going up, the stock prices were going up, we were talking about a 10-year decadal story. When the IT stocks are falling, we are talking about the story being broken. But my belief is, It's a long-term story. The growth rates are still going to remain around 10 to 15% where they were in the past, and much higher than what it was in the last decade. And if that is the case, the valuation slump is going to provide us the opportunity. So I'm not really worried about the Indian markets, because my belief is the median itself has to change. It's not that the pendulum has swung on the other side and we are way off from the median. The median itself has to change. So I would sort of, but the biggest part here, I would say, is that in this volatile market, the one thing we need to remember is what we do with the asset allocations, because that's what is going to play a key role. The allocations are going to play a key role, and that's the challenge for us, that how do we manage allocations through this volatility, rather than thinking about what will happen with volatility or what will happen with anything else. And to end with, I would say the opportunities are always thrown by sort of the bad times. So current scenario actually is throwing a lot of opportunities in certain areas, in certain pockets of the market. And it's time to remain invested and invest more rather than sort of get out of the market. So thanks a lot, and